For the purpose of calculating annual interest, it might seem reasonable to assume that a year has 365 days. However, in practice, interest calculations don't always assume that this is the case. A year for interest calculation purpose can have 365 or 366 or even only 360 days. What's more, that is, individual month can contain more or fewer days than you might expect. Depending on the day count basis on which interest is calculated, the amount of interest is different for the given principal amount, interest period, and interest rate. There are two types of day count basis, which is money market basis and bond basis. We'll look at bond basis first. Bond basis is the day count convention that is typically used with fixed income securities. There are a number of different conventions in this category. First is actual over actual. This is the most commonly used convention in bond markets worldwide. Actual over actual, which is used with most government bonds and many corporate bonds, uses a day count fraction equal to the actual number of days in an investment period divided by the actual number of days in the year, which can be 365 or 366, depending on whether it is a leap year or not. The second is actual over 365. Actual over 365 basis uses a day count fraction equal to the actual number of days in an investment period divided by 365. So that is the usual number of days in a year. This method is used by some supranational and corporate bonds. And finally, we have 30 over 360. This uses a day count fraction that assumes there are exactly 360 days in a year. This is commonly used in the US corporate bond market. Let's look at an example. James is a fund manager with ABC Asset Management. Recently, he invested $1 million in a bond, paying an interest rate of 5% annually on a bond basis, which is actual over actual. The bond is to be held for 1 year, at the end of which the fund will receive the principal plus the interest. Assuming this is a non-leap year, so how much interest will the fund manager, James, receive after 1 year? So the answer is US dollar 50,000, which is 1 million times the 5% times 365 over 365. Thanks for watching. For the next session, we will look at the money market basis and the links between the bond and money market basis.